Welcome back to Investing Talk podcast.
Glad to be here.
Today we're looking at a stock that, well, if you follow emerging tech or energy storage, you've definitely noticed it. SES AI Corp.
Oh, yeah. Hard to miss the recent action.
Absolutely incredible volatility. I mean, the stock's up over 66% in the past year. And then just in the last day or so leading up to September 19th, it popped more than 20%.
Right. And that kind of really sharp move, it just forces you to stop and ask, okay, what is actually driving this? There's a mix of strategy, maybe some speculation that's put SES AI Corp really on the radar. So the core question, the one we're exploring today, is pretty straightforward. With all this noise, all this momentum, is it actually a good time to buy now?
Exactly.
We'll be digging into, the recent catalyst, looking hard at the financials, the good and the bad, and weighing those risks, because there are risks here.
Definitely. Okay, before we jump into all that, just a quick reminder for everyone listening, please do subscribe, like this conversation if you find it valuable, and definitely leave a comment.
Yeah, and tell us if there's a specific company you want us to look into next. We really do check those comments.
We absolutely do. All right, let's get into it. The momentum. What's been happening these last 3 months? Seems like some pretty big moves.
There have been, yeah. Major strategic shifts that have definitely boosted visibility.
The big one seems to be that UZ Energy acquisition. That just closed, yesterday, September 18th?
That's the one. Closed yesterday.
Now, that feels maybe a bit surprising. A battery tech company buying an energy storage systems provider. Seems like a pivot.
I wouldn't really call it a pivot. It's more like accelerating the commercial path. It's actually quite strategic when you look closer.
Okay, how so? What makes it strategic?
Well, first off, UZ Energy gives them an immediate, tangible commercial footprint. They instantly added over 500 megawatt hours of existing ESS deployments.
Existing, so we're talking actual systems out there running.
Exactly, not just lab experiments. And maybe even more importantly, it expands their reach, their operations, across something like 60-plus countries globally.
Wow, okay, so it's not just theory anymore. It's like, boom, you've got instant market access.
That's it, precisely. And they're tapping into a huge market, the global ESS space. I mean, projections are heading towards $300 billion.
Huge number.
But the real prize here, at least what the sources seem to suggest, is connecting their specific battery technology.
Their lithium metal tech.
Yeah, their Li metal tech, potentially with its AI safety features, to the massive and rapidly growing energy needs of AI data centers.
Ah, the AI data center angle. Why is that the specific focus? Don't they just need basic backup power?
Not anymore. Not with these hyperscale AI operations. They need incredibly stable, really high density, super reliable storage. We're talking managing huge fluctuating power loads 24/7.
Okay, much more demanding.
Way more demanding. And SES is lithium metal, so especially combined with their AI for battery safety. Well, the idea is it could offer a better solution than traditional lithium-ion, which might struggle with the density and, crucially, the safety profile needed for these AI workloads.
So it's an aggressive play to get ahead in that specific high-value niche.
Exactly. It's trying to carve out an early lead.
Makes sense. So the acquisition is really about commercializing their core IP. Now, on the corporate side, they also brought in Andrew Boyd onto the board.
Yeah, earlier this month, September 3rd.
He's a big name in capital markets, right?
Oh, yeah, definitely a heavy hitter. And appointing him, that sends a pretty clear signal to the market.
What kind of signal?
It says SES AI Corp isn't just R&D anymore. They're seriously gearing up for growth, whether that means tapping capital markets more effectively, maybe managing big strategic investments down the line, or navigating complex partnerships.
Having someone like Boyd gives them credibility.
Serious credibility, especially with institutional investors. It's a validation point.
Okay, strategy aside, what about the tech itself? Any validation there? We heard about this. MU-0.5 Molecular Universe software.
Ah, yes, the latest version.
What exactly is that? And why should we care if, 30 companies are trying it out, even a couple of OEMs?
So think of Molecular Universe as their digital brain. It's essentially an AI-powered simulation platform for battery chemistry.
Okay.
It lets their engineers, and potentially their partners' engineers, simulate, test, optimize battery materials and designs all in a virtual space before they even build a physical prototype.
So it speeds things up, improves safety.
Exactly. Speeds up R&D significantly, helps predict and improve safety, allows for customizing battery designs for very specific uses like an EV versus a huge grid storage system.
Got it. So the fact that OEMs, these big, cautious manufacturers, are actually using it in trials, That's more than just a footnote.
It's a pretty big deal, yeah.
Yeah.
It suggests these established players are integrating SES's proprietary digital tools into their own design processes.
Which validates their claim about integrating AI for battery safety into the whole lithium metal process.
Precisely. It backs up that core competitive advantage claim. Because look, lithium metal batteries, they're powerful, but notoriously tricky. Safety, stability, scaling, those are the hurdles. This software is key to managing that.
They're trying to be the first mover, really nail down that lime metal space.
That seems to be the goal.
Which brings us nicely, or maybe nervously, to the financials. Because we've got this great strategic story, tech validation, but the numbers, they paint a very contrasting picture.
They certainly do. It's a real paradox.
Right. Let's start with the good signs.
Okay, well, Q2 2025 revenue was $3.5 million. The full-year guidance, that's holding steady between $15 and $25 million. So there's revenue coming in.
Okay.
But the number that really jumps out, the one you have to grapple with, is the gross margin.
74%. 74.34% on a trailing 12-month basis. That just sounds astronomical for advanced manufacturing. Can you, put that in context?
It is exceptional. I mean, really high. When you see a gross margin like that, north of 70%, it usually tells you a couple things.
Okay.
One, their cost of goods sold right now is probably very low compared to revenue. Maybe that revenue is coming from, say, licensing or specialized engineering services, maybe small, high-value initial batches. It's not mass production costs yet.
Right, not scaled up.
Not scaled up. But two, and this is the crucial part, it strongly suggests there's significant perceived value in their core technology, their IP. It implies they could have serious pricing power if they reach commercial scale.
So the message is, what we make is really valuable, high margin, if we can actually make it at scale.
That's a good way to put it.
Yeah.
But then you hit the contradiction, right?
Yeah, the big one. Despite that margin potential, they are losing a lot of money. Net income last quarter was negative $22.65 million.
A significant loss.
And that loss grew from the quarter before. How do you reconcile 74% gross margin potential with bigger and bigger quarterly losses?
Well, that's the textbook profile, isn't it? It's the classic risk-reward of investing in a pre-commercial high-growth tech company.
Explain that.
The high gross margin. That's the promise, the blueprint for what could be. It shows the tech itself is valuable, the big net loss. That's the cost of getting there right now. It confirms they're pouring money into R&D, into operations, burning cash to make that leap from the lab to, real commercial sales.
Okay, so the spending is expected, even necessary at this stage. But how long can they keep spending like that? What about their cash? Liquidity risk is huge for these kinds of companies.
That's the immediate question, always. And here, the news is actually quite good. Their liquidity looks robust.
How robust?
They're sitting on about $229 million in cash. And critically, zero long-term debt.
Zero debt, that's unusual.
Very helpful. And the analysis suggests this cash position, this runway, is enough to fund operations through 2028.
Through 2028, so 3+ years.
Yeah, that's a significant runway. It takes immediate pressure off. They don't need to desperately raise capital tomorrow and dilute shareholders. It buys them crucial time to execute to try and hit those commercial milestones.
Okay, so summing up the financials. Potentially very valuable tech, requires heavy investment right now, but they've got a solid war chest to fund it for a while.
That's a fair summary.
Which leads us right into looking forward. What's coming up? What events or catalysts could move the needle in the near term?
All right, looking ahead, there are a few key dates and events on the calendar. First up, pretty soon actually, is an ETF rebalancing event on October 9th.
How does that impact things?
Well, if SES AI Corp stays in certain key tech or energy ETFs, those funds are basically forced to adjust their holdings. Often that means buying more shares, which can boost trading volume and push the price up, at least temporarily, due to that passive inflow.
Interesting. Okay, what else?
Then you've got the institutional buy window opening on November 4th. That's when certain rules might change, allowing more professional institutional investors to potentially step in or increase positions.
So more potential buyers coming online.
Potentially, yes. And then the big one, fundamentally speaking, is the Q3 2025 earnings release, expected around December 9th.
Why is that one so crucial?
Because it'll be the first earnings report after the UZ Energy acquisition closed. Investors will be laser focused on any commentary, any early data about how that integration is going. Is it translating into actual growth in that ESS segment? They'll want hard evidence.
Right, proof the strategy is working. Now, let's talk about the less concrete stuff, the rumors, the speculation. That seems to be driving a lot of this recent 20% spike. What's the chatter?
Yeah, there's definitely some speculation fueling the fire. Three main themes seem to be circulating.
Okay, what's number one?
The loudest buzz is probably around a potential major AI data center partnership. The dream scenario, right?
Yep.
Imagine they announce a deal with a huge global cloud provider, supplying advanced batteries specifically for those next-gen hyperscale data centers.
That would be massive validation, huge demand.
Absolutely game-changing validation for the tech in a very demanding application.
Okay, what's the second rumor? Does it relate back to EVs?
It does somewhat. It's chatter about a large automotive OEM or maybe even a big electronics manufacturer considering a strategic equity investment.
So like a car company taking a direct stake in SES AI Corp.
Exactly. If a major player like that invests directly, it signals huge confidence in their ability to scale the Lime metal tech. Plus, it can mean non-dilutive funding and maybe even guaranteed future orders.
Another potential game changer. And the third rumor, you mentioned that software earlier.
Right, the molecular universe software. The third bit of speculation is that they might transition that platform into a broader SaaS software as a service licensing model.
So selling access to their digital chemistry tools as a subscription.
Yeah. If they pull that off, it opens up completely new revenue streams. High-margin, recurring software revenue. That would really change their business model, make them less reliant solely on building and selling physical batteries, which is very capital-intensive.
Interesting possibilities, but let's ground ourselves back in risk. Technically speaking, the stock's around $1.58 now. We know it's volatile. But that beta number you mentioned, 2.69, can you break that down? What does that really mean for an investor?
Okay, so a beta of 1 means a stock tends to move perfectly in line with the overall market, like the S&P 500.
Standard market risk.
Right. A beta of 2.69 means SES AI Corp is statistically expected to be 2.69 times more volatile than the market. So if the S&P goes up 1%, this stock might jump 2.69%.
Sounds great on the upside.
But the risk cuts both ways, sharply. If the market drops 1%, this stock could potentially plummet nearly 2.7%. It's not just volatile, it's showing extreme sensitivity to market sentiment.
So definitely not for the faint of heart.
Absolutely not. It screams high risk, high reward.
Right.
This is firmly in the emerging tech category, really only suitable for investors who actively manage their risk and can stomach huge, rapid price swings.
Given that extreme risk profile, what are the absolute biggest red flags, the main worries investors need to keep front and center?
Number one, without a doubt, is execution risk. It's just incredibly difficult to scale up lithium metal battery technology reliably and cost-effectively.
What kind of difficulties?
Things like preventing dendrite growth, these little metallic spikes that can cause short circuits, maintaining stability and safety in larger cells. Just the sheer engineering challenge of going from controlled lab batches to mass production in gigafactories, it's immense if they hit unexpected roadblocks in scaling or reliability.
The whole story could unravel.
The whole investment thesis is threatened, yes.
And linked to that execution risk is the financial risk.
Directly. The risk of sustained losses. Yes, they have cash through 2028, which is great. But if commercialization takes longer than planned, or if those initial contracts don't deliver the expected margins, those significant net losses and the cash burn will just continue.
And that 2028 runway isn't infinite.
Exactly. If they don't reach commercial viability, eventually, even with that runway, they will need to raise more capital, which usually means dilution for existing shareholders.
Okay, execution, sustained losses. What about competitors?
That's the third major risk area, sector risk. This isn't a vacuum. They face intense competition.
From established battery makers.
From them, yes, but also from other aggressive, often well-funded startups working on next-gen batteries, especially in the solid-state space companies like Solid Power, QuantumScape. It's a fierce race.
A race to capture the future of batteries.
And winning that race is far from guaranteed. Plus, their valuation will always be somewhat tied to the ups and downs of the broader EV market cycle, which adds another layer of volatility.
Okay, let's try and tie this all together. It feels like a classic conflict for investors. On one hand, you have potentially groundbreaking technology, shown by that incredible 74% gross margin, plus zero debt and a solid cash position through 2028. That's compelling.
Very compelling potential, yes.
But offsetting that, you have these very real, very significant risks. The ongoing losses, the extreme volatility highlighted by that 2.69 beta, the execution hurdles, and a valuation that still feels largely based on future promise, on speculation.
That sums up the conflict perfectly. And based on our sources, looking at all this conflicting data, the overall analyst consensus seems to land at about a 4 out of 10 rating for the stock right now.
A 410. So not exactly a screaming buy recommendation.
No, the consensus suggests it's really more suited for speculative short-term momentum traders, people looking to specifically play that volatility, capitalize on the news flow, the recent announcements.
Okay. But what about someone who truly believes in the long-term potential of lithium metal batteries? Someone willing to hold?
For that investor profile, the guidance is pretty clear. It's only suitable for very high-risk investors. You have to be comfortable with the very real possibility of losing a significant portion or even all of your investment while waiting to see if they can actually commercialize successfully.
So conservative investors should probably stay on the sidelines for now.
That's the advice. Wait until there's much clearer visibility on commercial scaling actually happening, on adoption metrics improving, and critically, evidence of a tangible path towards profitability. Wait for more proof points.
Okay. So building on all that analysis, we know the cash runway looks secure through 2028, which definitely reduces that immediate financial pressure. It seems the ultimate make-or-break question for long-term value comes down purely to technology adoption. They need to prove it works at scale and that customers will buy it.
Absolutely. It all hinges on adoption.
So here's a final thought for you to consider. Beyond just integrating UZ Energy and targeting the ESS market, what specific technical milestone or perhaps what kind of definitive partnership, maybe that major OEM investment or really launching Molecular Universe as a SaaS product, what would constitute that undeniable moment of commercial validation that long-term investors are truly waiting for? Think about what that specific catalyst would look like, because that's likely the point where the risk profile starts to fundamentally shift.